All right, good morning, everybody. It's Wednesday, January 8th. We've had a couple of weeks off from the Watercooler Wednesday. It just so happens that it landed on Christmas Day and then New Year's Day. So we didn't want to do these during those special holiday times. And hopefully everybody enjoyed that and had a lot of good quality time with family and everything else. But glad to be back and jump on it because 2025, man, we got a lot to look forward to, Dwayne, huh?
Oh man, there's a ton of opportunity out there. We need to jump on it. Start right from the beginning of the year. Time to go.
Yeah, I mean, we still have deals. I was working a little bit through the holidays, and we've got deal closing, I think, today or tomorrow. We've got more in the works. We're just waiting on self-directed IRA company to fund two other deals. So we've been moving right through the holidays, and I figured we'd spend instead of doing a case study today. Um, been thinking about 2025 and what we're most likely, least likely to see. And Dwayne, as you know, I've done state of the industry addresses now for, I don't know, 12, 15 years or something
Yeah.
like that. And can put a lot of research into those state of the industry addresses. In fact, at our event coming up in Arizona, which is going to be the noteworthy event, which if anybody wants to attend this event coming up, and you have the dates on that one, or can
Yeah.
look those up real quick.
Yep. Yep.
It's
Yep.
coming up in February in Scottsdale, Arizona, and it's called the Noteworthy event. And I've been associated with Noteworthy for a number of years now, and we've got some discounts and things like that. If you guys want to go and meet industry people, meet Dwayne, myself are going to be there doing presentations. You got those dates, Dwayne?
Yep. February 21st
Oh,
through
yeah,
March
through March
1st.
1st. Yeah, February 20. What is it in February?
28th through March 1st.
Okay, 28th through March
Yeah.
1st. And you can reach out to Dwayne and we can get you discount codes and things like that or more information if you'd like. And Dwayne, you want them to email you on that?
Yes, that'd be the best thing to do.
Why don't you go ahead and give that email?
So the email is Dwayne DuaneGibbs, N as in Nancy, M as in Mary, S as in Sam at gmail.com.
Great. And I'll put that in the link as well, everybody. But going to be a good industry event, and I will be doing more of a detailed state of the industry address. But I thought what we'd cover today is just some of the highlights and of what's going on, so we can have an idea of what we're facing. But first of all, this industry, the note-backed real estate-backed note industry works in all economies. It really does. It's one of these things where we have steady inventory levels in good times, and if there are bad times ahead, we actually do better. So it's really an interesting type of investment opportunity because of the different ways that we can invest within that same umbrella of real estate notes. And I'll talk more about that in just a minute here. But what I see on the performing side is I think that's just going to continue to be steady. I don't think there's going to be many changes at all in the performing notes. And the reason I say that is that that's not related to bank originated loans at all. So it has nothing to do with the institutional loans. When it comes to performing notes, institutions don't sell those because, well, they're performing. So that's out of the equation. So where are these performing notes coming from? They're coming from seller financed transactions. And if anything, I've seen a trend over the years is more and more real estate investors are incorporating seller financing into their techniques, more so than I've ever seen throughout my history in this business. So you've got a lot of real estate investors now whose business model is let's buy discounted real estate, fix it up, and sell it. But we know we can sell it at a better price quicker if we offer seller financing. And a lot of real estate investors used to avoid that in the past because they didn't understand, they didn't have the connection that they could turn around and sell that paper in full or in part to recapitalize and move on to a different deal. They figured we just need to sell it and get money so we can do another deal. Now they've realized that this industry is so liquid, they can create paper and sell it before the first payment's even made, or after the first or second payment has been made. And that's been a game changer. So if anything, I've seen an increase on the amount of seller finance notes that we're going to have in the future, simply because not only have individual real estate investors recognize that fact, but so have institutional investors. Somebody who does it on a larger scale have recognized that as well. Land sellers have recognized that also. So we're starting to see a lot more people saying the heck with, waiting for financing on banks and having people go through that. Just finance it with us. The criteria is lower, and we can turn around and cash out of that paper as we need, and everybody makes a profit from that. You know what I saw recently, Dwayne, and I don't know if you've seen that. I know we follow a lot of the same folks on social media and stuff, but I just started seeing for the first time ever, and it makes total sense, is there's now companies promoting to developers, home developers, go in, buy land, build a subdivision. They're telling them, if you're not offering financing, you're losing
Mm,
out of millions and millions of dollars. I've never
yeah.
seen it get to that level before. Have you? Have you seen that at all?
No, I mean, you're saying this to me now. I haven't seen that. So it makes sense, makes perfect sense. But why they haven't done it in the past, I mean, it's a good question why, but I've never experienced that or seen that.
That's crazy, right? I mean, imagine, and I'm not saying this is happening right now, but I was just out in Reno, and Toll Brothers, I
Mm,
think most people listening to this would know who the Toll Brothers are. Huge, huge, huge developers. And I'm not saying at all that they're doing this, but I'm just saying, imagine if this got to that level where a company like Toll Brothers comes in, builds a subdivision, and you don't have to go through a bank. They do the financing on it.
hmm
And then they can either hold that paper or they can turn around and sell that paper. It
hmm
makes complete sense,
Yeah,
because all they're getting away from is that institution. And more people just hate going through the banks trying to get loans and being financially scrutinized on everything,
absolutely.
having to show all of their financial information and being held back by certain restrictions put upon the banks by the federal government, versus Toll Brothers can say, hey, here's our qualifications. You're fine. Show us that you have the ability to pay this, right? So there'll
hmm
be absolute verification. And then let's get it done and create that paper, knowing that they can turn around and cash out of that paper. Now, I don't think that'll happen, that level with a company like Toll Brothers, because they're massive, they're nationwide. But certainly already I am seeing smaller development companies starting to wake up and go, why are we sitting on these empty homes holding inventory, which is a cost, a deficit to them? Why are they doing that when they can turn around and sell it with financing a lot quicker? And then if they need to cash out of the paper, cash out of the paper. There's plenty of larger investments, private equity firms that would scoop up that paper. So I definitely see that as a trend starting in 2025 and then expanding from there. It just makes sense. I think people today are starting to recognize we have so many regulations and everything today. It just holds back commerce. And if we can get away from some of those, I think things will start to happen a lot quicker. So I'm interested to keep an eye on that, and I'll send you over when I see some stuff like that, Dwayne. I'll send it over to you. But I just started seeing that.
Yeah, do that. I would think that the opportunity too for business owners that would that would open up a big door for them, because as a business owner you try to apply for loans and all, and well, I'm a business owner, and you have to go way through as greater red tape and proving all this information to qualify. So I wonder if that's going to be not as strict and more opportunity for business owners.
I think so, because again, when you're a business owner, you want to be a smart business owner, which means take every legitimate tax break that you can get. Structure your
Absolutely.
business to pay the minimal amount in taxes, 100%. And but when you go to get a loan through the business goes, well, you don't make that much money. It's like,
Hmm. Yeah.
we do. It's just we structure our business in a way that we want,
Right. Right.
we don't want to show all this as income. We want to certainly use every benefit that we can to avoid taxes. That just makes sense. So it does make it tougher to get a loan. And to that point also, at some point in time, businesses get tapped out where the bank says, we think you got enough,
Hmm.
and they can stunt growth in a way like
They
that.
count your money.
Yeah.
They
And then
don't want you to
businesses,
count theirs, though.
right. Then business owners have to form a different business. And it's just, the whole thing's a mess. So hopefully, some of this regulation goes away. So performing notes, I see no problem there. I see just an increase in the number of performing notes that we're going to be seeing, and also just a final pinpoint on that. There's also notes that have been heavily seasoned now that a lot of investors that have owned notes for the past 5, 10, 15 years are looking to cash out, and seek other opportunities because they've made enough money on some of these deals where they're like, you know what, let me cash out of the rest of this note, build up a lump sum, and then I'll start to rebuild another new portfolio. And we're starting to see, and have been seeing that as well. On overall economic news in 2025 that will affect us, once again, credit card delinquencies have continued to go up. That's a precursor to foreclosures. But before credit card goes bad to foreclosures, it's auto delinquencies. Auto delinquencies are also continuing to go up. So there are absolutely underlying concerns when it comes to debt overload and people's ability to afford that debt. And the domino always falls. It goes credit cards, automobiles, and then home loans. That's just how it's worked. If you go back historically and look back in the last 30 years, that's exactly what the pattern has been. Every time we've seen a big delinquency in home loans. So what's happening there? And is that a sign that we're going to see more non-performing loans in the future? And I don't have a good answer for you on that. I've seen other people in our industry. Oh yeah, there's going to be massive amounts of non-performing loans, and keep your powder dry on the side and that sort of thing. But they've been shouting that from the mountaintops for 2 years. It hasn't happened. I wasn't one of those people because it's not the same. People have equity this time around. Banks are under pressure, high pressure from the federal government through Fannie Mae and Ginnie Mae to do workout resolutions with people way before they start foreclosure. It's government mandated. So it kicks the can down the road for these lenders, and you just don't see that kind of volume. Now, the thing that could really mess that up is the bond market. And I don't want to go down a deep rabbit hole here, but the bond market is concerning. Interest rates on bonds are going up, and they went up pretty drastically recently. And you would think, well, isn't that a good thing for a bond investor? It is if you're buying bonds now, right? So if the bond rates are 5.5% and you're buying now, good. You've got a locked in deal. You pay whatever for the bond, say 50 grand, and now you're making 5.5% guaranteed by the federal government. Okay, you're doing good. But what if you bought a bond for $50,000 2 years ago and you bought it at 2%? So now all of a sudden you want to sell your bond and cash out. Why would somebody give you 50 grand for your bond at 2% when they could buy a new bond for 50 grand at 5.5? The answer is they wouldn't.
Yeah. Yeah.
So if you want to sell your bond, guess what? You have to sell it at a discount, right? So now, and I didn't do the calculations on it, but let's just say now you might have to sell your bond for 30 grand. Why would you have to sell it for 30 grand or whatever that number comes out to? I'm not doing the exact math.
Yeah.
But you have to discount that 50,000 enough so somebody can make at least 5.5, probably 6%, because they could buy a brand spanking new bond for 5.5 right now. So if you want to incentivize them, you might have to discount to where they can make a 6% yield. So maybe you can only get 30 grand for your bond. Okay. That's the basics of it. Now, let's say that you're a bank. And a bank, you can add 3, 4 zeros on there. So maybe they've got $100 million worth of bonds at 2%. And now new bonds are at 5.5%. That is a phantom loss. If those banks were in trouble and they had to sell those bonds to raise capital, enormous amounts of losses. That's what's happened, by the way, to the last 3 banks that went out of business. and got absorbed by other banks. It was the bonds that they held, because bonds
Mm.
are safe, but when interest rates, if you have them here and interest rates goes up, that's what crushes them. And they just have that what they'll call unrecognized losses. And big banks, even your Chase and Bank of America, they're sitting on huge,
Bonds.
huge
Yeah.
unrecognized losses right now. And that's the potential problem, because if the banks start to tumble, then we've got a big financial hurt. Then you've got more people who are not um, going to be able to make payments, and we've got some real problems. So that's something to take a look at. The
You
other
were
part,
talking about credit card debt. You know, I was reading something the other day about Black Friday. People put on credit cards. $41.1 billion was spent on Black Friday online. Online. 41.1 billion. Largest ever in history.
and you're right, and probably by people who already had enough debt, but you got to have presence, you got to have, it's yeah,
I guess it's called optimism. You know, everybody's
yeah.
optimistic that, hey, 2025 is going to be so great that I'm going to be able to pay this off. But the rates, credit cards, I don't care if you have good credit or not. You know, your rates are ridiculous on these credit cards.
Oh yeah, they go up to 24, 25%, which really is
Yes.
insane. That's not
I mean, it's nuts.
that's not right. We can't write a mortgage loan for 25% without the government coming in, but big banks can get away
But
with it.
imagine somebody having, four or five in a family. They have a home, both husband and wife are working, and they spend $5,000 on their credit card, and
Mhm.
they have marginal to bad credit. They're paying 34, 36% on their credit card.
Yeah, it's nuts. And who knows? I know there's legislation right now, and somebody might be thinking about that, listening to this or watching this, which you can rewatch this, by the way, on YouTube. I always post the full video on YouTube. Um, But whether you're listening or watching, yes, I do realize there is legislation out there right now to cap credit card interest rates at 10%. But even at 10%, when
Mm.
people look at the numbers with some of the average balances that I've seen, they're looking at 28 to 30 years to pay that thing off if they just make the minimum payment. So it's an ongoing long-term problem that that people are facing. And it could lead to more bankruptcies. And when we see an uptick in bankruptcies, which we have already, that's again not a bad thing as a note investor, because we can buy those notes that are in the process of bankruptcy, have already been approved for bankruptcy, and those can be really outstanding loans for us to buy because we get them at such a discount. That's the thing. We can look at the value of these assets and the potential of these assets, and it always comes down to that difference of price and value. And if we can get them at a great price, then the value is there. It's a fantastic deal. So that's why one of the other reasons why I say if the economy does get worse and we do start to see the credit card debt, the auto debt, and the pressure of paying the mortgage go up, and people end up declaring bankruptcy and seek that kind of protection, that's that's going to be good inventory for us as note investors. And again, don't think that we're vultures and preying on people. We didn't get into that situation. We're actually helping them out. We're buying that note and working with them either through the bankruptcy process or after they've declared bankruptcy. It has no effect on them at all. It's just a matter of what we purchased that note for. So again, we are in the business really of helping people uh, whether we buy performing or non-performing loans. So the other thing of concern with real estate that would affect real estate notes, there are some bubbles. I live in one in Florida. Um, More specifically, I could make a real strong case study for a huge bubble in South Florida,
Mm.
Miami, Fort Lauderdale, Palm Beaches. Those areas are in a big bubble. Miami specifically, the prices are absolutely insane in Miami. And what's happening in Florida is insurance companies are pulling out. big time. Insurance rates are unbelievable for homeowners insurance in Florida. And not only do you need just a regular policy, then there's a separate policy that you need for hurricanes because
Yeah.
regular insurance won't cover it. So that you have a rider on top of that. And people in Florida have seen their homeowners insurance triple, especially if you're along the coast, and
Oh,
Fort Lauderdale and Miami and the Palm Beaches, all on the East Coast of Florida. It's absolutely crazy. You add on top of that the HOAs, homeowner associations, and condo owner associations. Their dues have tripled. There are stories down in South Florida where people are what the condo associations now, because of the collapse of the condo down there. So there's reasoning behind it. All condos have to go through extensive inspections and everything else and be brought up to code because, after all, a whole building collapsed in Miami. Hundreds of people died and everything else is very tragic. So they're looking at all of those things, and again, that's why insurance rates are going up. But condo associate, if you live in a condo, which is very popular down in those areas that I mentioned, the HOA comes to you and says, "Hey, everybody, you got to come up with 200 grand each because we have to get this inspection and this has to be fixed and that has to be fixed." And you got to somehow come up with the money. Or they do what? They put a lien on your property, and HOA liens can eventually take away your property. I mean, it's crazy. So there are people even up as far as Ormond Beach. I was reading a story which is north of Central Florida. In Ormond Beach, I was reading the story of a guy. He bought a condo for like $250,000, maybe 5, 6 years ago, on the beach. Beautiful, loves the lifestyle, everything else. But the HOA has gone up to this year. They got to pay over $100,000, and he goes, I
mm,
just can't do it anymore." He goes, I can't do it. We get reassessments, and he goes, plus he goes, I can't get insurance anymore. And he goes, it's just ruined it. You just can't live that kind of lifestyle on that budget, and it's crazy. All the new regulations that have come in have increased the costs of new homes, new condos, and everything else. So Florida is definitely a good case study of a market that we have a lot of people moving in. It's desirable. A lot of people coming in from other places, California, that sort of thing, because of our tax-free state. We don't have state income taxes, and the lifestyle and everything else. So we have plenty of demand, but the cost is going up through regulations, through insurance, through HOAs, and it's really causing a problem. So I think there's other bubbles around the country that are doing the same thing. I don't know what's going on in the Carolinas. Maybe you got some insight on that, Dwayne.
well, I can tell you from being from Southwest Florida and Fort Myers, and so many friends that live down there, they're saying that they're getting letters from insurance companies that they're letting them know ahead of time, you're going to need to find another insurance company because we're not carrying policies in Southwest Florida anymore from all the hurricanes that they're having, and it's just drastic. It's tough. North Carolina, we're finding a big uptick in that as well. Insurance is going up. I just got renewal on all my policies, auto, car, just because of the devastation here in the west coast of North Carolina. So I'm not far from it, 40 miles from it, and all the devastation. I mean, I saw on the news last night, they were talking about the cold weather because it's getting really cold here, and people are just living on the streets everywhere because such a mass destruction of area, and everybody's having to rebuild. Insurance companies, same thing. That money has to come from somewhere, and so what's going to happen? And they're just insurance companies are taking a beating, and everybody's going to feel the effect from it.
Yeah. And I'll tell you what, I am on the opposite side of the country right now, and about 200 miles north of me,
Yeah, major
fires
fire.
are out of
Fire
control.
ridiculous.
And now I was reading this morning, because I mean it's a couple hundred miles up the road. I don't think it's going to come down where I am, but it's
Major.
tragic. And you start to read that insurance companies a month ago already sent out notices to people going, "We're dropping your insurance."
Yeah.
California regulations, once again, regulations are too expensive. We can't do it. They've done a horrible job about deforestation. I'm not going to get into all that sort of stuff, but in trying to prevent this stuff. I mean, every year you hear this stuff. It's like, hey, hello, maybe you want to, get ahead of the game here. Now, what's happening up in Pacific Palisades is there's no water in the fire hydrants.
It's
So the
terrible.
firemen are literally going, there's nothing we can do but let it burn. There's no water in the hydrants, So the insurance companies, a lot of these people that are losing these multi-million-dollar homes, they have no insurance anymore.
And we're not bashing the insurance company. It's just the way it is. I mean, the money has to come from someplace.
Yeah.
So,
Well, insurance companies are like any business. They're in the business to make money, right? And
absolutely, absolutely,
they
absolutely.
recognized like, hey, we can't afford this because if a fire comes through, our company and our shareholders will be
Sure.
wiped out. So they did
Yeah.
what any responsible business owners would do is just say, hey, we can't do it. And there's no fallback. And it's a big deal. So I think insurance is going to continue. They're going to have to come in possibly with, some new regulations or something on that. And that's what leads me to the last thing here, which is the unknown factor. And the unknown factor right now is the Trump administration. What are they gonna do? I mean, it looks like they're coming in guns a-blazing on cutting regulations and getting the economy going and everything else. But again, the president doesn't have all the control in this company or a country, which should be run like a company. But you still have the House, you still have the Senate and everything else. So a lot of these things could slow down, could have to be adjusted, could be curbed back. We just don't know. And anybody who's trying to say, here's what's going to happen with the new administration, they're guessing at best. I mean, we just don't know because again, there are other hurdles that go through. I'm optimistic. I think most people in the country are about what they're doing. I think we do need to swing back the other way. We've just gone out of pocket. And it's funny here in Southern California, just yesterday, talking with groups of investors, I was really kind of surprised. People are tired of it. They're going, we need to change. We're just
Yeah.
done. And you don't hear that much out in California. I didn't think, and a lot of people just going, yeah, we're overregulated. We need stimulus. So
It's tough.
I think
It's
people are
tough across
ready.
the
Yeah.
board.
I think people are ready for some positive changes and are more receptive to it. And look, I'm not political grandstanding and I don't have look, I've said this before. I started this back in the Reagan administration, and then it went through the Bush administration, then it went through Clinton. After Clinton was who's after Clinton? Um, oh, was that
That was Bush.
Bush again? Yeah. And then Obama, and then
Hmm.
Trump, and then Biden, and now Trump again. Been doing the note business through all of that, different cycles, different things going on the whole time. It doesn't matter. What matters really, it's not the market that should dictate what your profits are, it's your strategies. So what are your strategies within all of those markets? Because each one has brought in different kinds of legislation, technology's been increasing over time, and you just adjust. It's the same industry, but it's just you adjust your strategies. That's what's important. So I'm not as concerned really as much as who's in charge. And I don't talk politics as a professional speaker, but it's so pervasive in our world today that how can you not talk about it? So again, I think that I've always been one. I want less government restriction. When we first started in this industry, it was a bit of the wild, wild west. There were no regulations on seller financing. It was basically if I was selling a home to Dwayne was buying a house, we would just work it out together. We didn't need the government getting involved. It's basically, hey, Dwayne, you give me this down and I'll finance it for this and you make the payments to me. That was it. We didn't need
Yeah.
all this other regulations. I didn't have to qualify Dwayne if I didn't want to. I could have done a deal on a handshake with Dwayne if I wanted to. Okay. Now in real estate, you want to put it in writing, but I'm making my point being that we didn't have all this other restrictions. Now, if I'm seller financing to Dwayne, Dodd-Frank Act says I do have to qualify him a little bit, to make sure he can afford to make those payments. I'm okay with that because if I was seller financing to Dwayne back in the day anyway, I would have qualified him. I would have made sure he could afford, to pay it. So that's not a big leap. But if they start saying you need to have a license, you need to have this, you need to have that, that's too much government. Get the heck out of our way. Let us make money. So I do hope they come in, and it looks like through the help of Elon Musk and Vivek, is that his name, Vivek? The
Yeah.
other guy through the Department of Government, whatever they're calling it, Doge, um, that they're going to come in and slash some budgets and slash some restrictions and let people do more business and take more personal responsibility. And that I'm attracted to. That's what I've always liked.
Well, you don't hear of any more, and you would know way better than I know. Assumable non-qualifying mortgages. When did that end? Was that in 82 or 79? Am I off on the
It was
dates?
definitely through the 80s because I bought my first
Yeah,
townhome
so
through
because I
that.
was gonna say I bought my very first rental property on assumable non-qualifying mortgage, and so it was this is easy. Man,
Yeah.
how many of these can you do? And then all of a sudden, the big question is this qualifying or non-qualifying? You didn't ask about anything else. Qualifying, non-qualifying. Oh, it's qualifying. And then you kept seeing more of that. And I thought that it ended somewhere around 84. I'm not
Now,
exactly sure
because
on the date.
I graduated college 85 and I probably bought my townhome 88, 89. So yeah, I think it went a little longer. I think it's just when those loans kind of expired. And the good thing
I
about
got you.
those was, by the way, the guy I bought it from, I only had to give him $1,000 and I just agreed to make the payments. That was it.
Mm-hmm. Mm-hmm.
That was the whole thing. And then when I sold it, I basically just same thing. I forget how much money I got, but I said just sign here to take over the payments, and
Yeah.
it was pretty darn simple. And
Yeah.
yeah, who knows? I mean, maybe they come back with a new
Gosh,
financial instrument like that. Maybe they come back with some new loans and such. And that's what I mean. So there's definitely an unknown factor out there, but I think the unknown factor is going to be that we can do more things. I don't see the Dodd-Frank Act changing. That's actually worked pretty well, and it's worked pretty well for the note industry because it is creating better quality notes. Because
mm-hmm.
people do now, not everybody knows about Dodd-Frank Act, so there's still mom and pop notes that are not uh, qualified for that. But there are definitely more people who are in the business and institutions and small business people that are creating better qualified notes because of the Dodd-Frank Act. So I have no problem with that. But as long as there's no new restrictions, because there was definitely a move, you could see it where more and more states are saying, well, you have to have a lender's license if you're doing that. It's like we're not giving a loan. What do you mean we need a lender's license? We're
Mm-hmm.
buying a loan that somebody else already created. Well,
Yeah.
you need a debt collector's license. Well, what do you mean? This is a private debt. It's not an institutional debt. Why an agreement between two parties? Why does government have to get involved in that? Why would I need a debt collector's license? That sort of thing. So there's definitely and why are they doing that? Because states make money off of licenses.
Regulation. Yeah.
Jesus, I was out in Reno talking with the owner of one of the servicing companies out there, and he's licensed in every state. And he was telling me every state he has to about every year or every 2 years, you have to take the test, and he's got to requalify and got to pay more fees. And it's absolutely
North
ridiculous.
Carolina is ridiculous.
Yeah,
It's like $10,000. You have to take the test it's nuts.
yeah,
It's completely nuts.
it's a money grab. It's a government overreach money grab, and that's the kind of stuff that we don't like. So I hope that the new administration, it looks like that's what their intent is to come in here and just let people do business. And geez, I mean, it's kind of sad when the whole thing is, if I'm doing a business to business transaction, the government says, okay, well, you guys are in business. So if I'm a business and Dwayne's a business and I do seller financing with him, I don't have to qualify him for anything because he's in business. He should know better. I'm in business. I should know better. This is how the
Right.
government looks at it. But if I'm a business, a small business, LLC, and I'm working with Dwayne as a consumer, they go, well, Dwayne's uninformed. He's just a consumer. He doesn't know what the hell he's doing. So we have to step in and overregulate to make sure that that person's protected. It's like, really? You know, I get it. They're trying to set that up where you're not taking advantage of people, but at some point in time, people have to have a little bit of personal responsibility and understand what they're signing and what they're getting into, in my opinion. So we'll see what happens. But overall, we're going to do great performing notes. I still think it's going to be 80+%, maybe 80+% performing notes versus non-performing notes through 2025. Which is fine. There'll still be some gems every once in a while on a non-performing loan. Oh gosh, we just had one. This was a heartbreaker. It was a non-performing loan in Georgia, and a client of mine in California was buying this loan, and we're going through, and the holidays kind of jumbled things up. It's hard to get stuff done during the holidays, and we're trying to get this deal done and funded because we researched it to the point where the writing was on the wall. I knew so much about this deal. It's like you had these two people. They weren't a married couple, but they ended up buying a property, signing a loan, and the wife or the girlfriend, whatever the relationship was, she ended up passing away. He's now responsible for the loan. Well, then he gave power of attorney years later to a son. And in the meantime, the loan stops paying. I mean, I just knew the whole story just from public research. And I said, this non-performing loan, they're either going to sell the house or there's going to be some kind of a quick workout on this thing. And it's in Georgia. So if we don't get any feedback from the guy, it's a quick foreclosure process. And sure enough, before we could get it closed, guess what happened? Payoff. Paid off the whole non-performing loan. So I think they sold the house or it's under contract or something. There'll still be gems like that. They'll still be good non-performing. It's just you're not going to find them to the extent like it was in the last crash. It's going to be 80% or more performing notes and about 20% non-performing notes, and that's going to be our inventory. And I'm totally good with that because when you can buy these these performing loans where you're getting double-digit returns at a low risk, it's a fantastic opportunity.
Yeah, absolutely. Absolutely. So 2025, hopeful. I think just be prepared, do your homework, and there should be some great opportunities coming this way.
Yeah, 100%.
I sent you an email. I don't know if you want to post that out about where it's at the
okay.
For the golf club resort.
Okay, great.
Dates
Yeah,
and times and all like that. Yeah.
Okay. Yeah, I'll send that out to I'll put it as a part of this and when it's posted. And so hope you guys enjoyed that. Give you a little insight to my thought process. And if you're sitting on the sidelines, and you're not in this industry, the business, please email Dwayne and reach out to him and he'll send you a link and on Calendly and you can set up a phone call and just talk about it
Free.
and
It's
go into
free.
detail. Yeah, no cost, no obligation. We're just there's a lot of opportunity in this industry. We help people on a daily basis. We're closing deals on a weekly basis, and there's a lot of opportunities. So please reach out to him, and we'll get you on a phone call and see if it's right for you. See if we're a good match for you as well. If you're in the business already and you're stumbling a little bit or having problems with inventory, you're looking in the wrong places, we can help you with that as well. So again, reach out and we'll be glad to do that. In the meantime, we'll put together another one next Wednesday for you. And that's all I've got for today.
Perfect. Good session.
Okay, everybody.
That's it, man.
All right. Have a great rest of your day.
Talk to you soon.
Okay.